All right, so welcome to our Saturday webinar. So I'm going to be the speaker today instead of the usual Yin Sa, who is our CEO. So I'm just a substitute for just this one time, actually occasionally. So anyway, so hopefully you won't be disappointed. But if you're looking for to listening to Ying, so you can always come back on a different Saturday. So next Saturday, for example. All right, so let's get started for today's topic. So let me share screen. We're going to talk about some issues related to IRS audit. I guess some issues about the ERC, so that could be IRS audit areas. Okay, so quick a couple words introduction about myself. I'm a PhD, I'm professor, and currently I'm working at the Community CPA. So we have a website, communitycpa.com, and then later I might show you our phone number and other information. Okay, quick, simple no responsibility disclaimer. So just by attending this webinar, that does not form a client relationship with us. So we, although we do our best to compile the information presented, so we are not responsible for people relying solely on listening to this webinar. And of course, you're always welcome to become our client in order for us to best serve you. And then, of course, in that case, we will be taking whatever our responsibilities will entail if you're a client. All right, so we're going to talk about the ERC audit. And so first, let's quickly recall that for the employee retention credit, the ERC, and not every employer is eligible. And then even when you are eligible, it does not necessarily mean you are eligible for all quarters. Okay, so there are 6 to 7 quarters, depending on the type of employer you are. So it's going to be, in fact, can even be 8 quarters in some extreme cases. But these are the quarters in 2020 and 2021. Okay, so again, so there's eligibility issues, and you may or may not be eligible. And then even if you are eligible for some quarters, you may not be eligible for some other quarters. Okay, and then also quickly mention that the first quarter 2020, even if you are eligible, typically it's going to be only for a short period in March, between March 13th through March 31st of 2020. And then for fourth quarter 21, and you will be eligible only if you, and you can be eligible only if you are a recovery startup business. So there are some limitations on that to begin with, but then of course, even for the quarters in between, from the second quarter 2020 through third quarter 21, you still have to check quarter by quarter, see if you are eligible. Okay, and we'll talk more about the eligibility in the next slide. Okay, so we don't have too many slides, but each slide is going to contain a lot of information that we'll be talking about. All right, so that's eligibility. And then, so once you have determined you are eligible for certain quarters, and then for each quarter, you want to do the calculation and to see how much ERC credit you can get. So for ERC credit calculations, there are several things, basically there are several exclusions or caps. For example, so there's a per employee cap. And so again, we'll go into the detail later, so not just quickly mention. So there is a per employee cap, and so there's also, you have to exclude wages paid by PPP or other federal programs, or wages of certain owners or owners' relatives. Okay, and and then of course the main thing we're talking about, as in the title says, we're trying to address the areas where the IRS, the areas IRS will look at, or will may look at during a ERC audit. Okay, and so ERC audit, the IRS does have 5 years instead of the standard 3 years to do the audit. Okay, so and also the way to count the 5-year statute of limitation is from April 15 of the following year. Okay, so we're talking about the 941 quarterly findings, but the clock does not start from right after the quarter that you're claiming the ERC. It's actually the April 15 of the following year. So I'll talk a little more about that on the next slide. Okay. All right. First of all, IRS audit on ERC is coming, and in fact, there are rumors that some people have already been, and some employers have already been contacted about, for ERC audit. And so we do note that there are recent legislations that allowed IRS, that allocated the funds for IRS to hire more people, and IRS has been hiring and will continue to hire in the next few years and hire and train employees for compliance examinations, and which would include ERC audits. And in the prior slide, I already mentioned, so the ERC statute of limitation is 5 years from the April 15, and of either 2021 or 2022, and depending on which quarters we're talking about. Okay, so if we're talking about the quarters in 2020, so for example, whether it's the first, second, third, fourth quarter 2020, okay, so they actually all the statute of limitation clock, the 5-year clock for all quarters in 2020 starts from April 15, 2021. Okay, so if you go 5 years from that, so that will be April 14 of 2026. Okay, so for for the ERC in 2020, so these are related to the 941 that were filed in 2020. So the examination period goes all the way to April 14 of 2026. Okay, so that's 5 years starting from April 15 of 2021. Okay, and then if you claim ERC for a quarter in 2021, okay, so for the 2021 quarters, that doesn't matter which quarter it is in 2021, and the clock, the statute of limitation, the 5-year statute of limitation clock starts on April 15 of 2022. Okay, and then again, if you count 5 years from that, so that goes all the way to April 14 of 2027. Okay, so IRS has plenty of time to do the examination, and of course that's also good for you as an employer to make a claim. If you have not claimed the ERC, and if you are eligible, and then you do have qualified wages, and then you'd have plenty of time to claim. So that statute of limitation is actually the period for IRS to resolve any issues or make make assessments, including making assessments, but also could be resolving any issues. So for example, if you made amendments, that's typically what how the ERC is claimed. So that's the 941 amendment. Okay, and of course, original findings 941. I put the -X in parentheses because ERC can be claimed by either the filing of the 941 directly, or you make an amendment subsequently. Although the majority of people are using the amendment because you filed the 941 in 2020 or even in 2021 without worrying about the ERC, and now just probably in 2022 and maybe it's part of 21, so you started making those claims. Okay, so but anyway, so 941 and 941X, you should consider them in the same category as far as for the IRS audit or the accounting, the statute of limitation, the 5-year statute of limitation. Okay, and the when you make a amendment that does not alter the starting date for the 5-year statute of limitation. Okay, so and even if you claim in 2022, that does not mean your clock will start in 2022 or even 2023. Your clock for a 2022 941 or the ERC claim is April 15, 2021. Okay, so likewise, for any quarters in 2021, you claim the ERC, and the 5-year statute of limitation clock starts at April 15 of 2022. And also note that if IRS determines a certain ERC claims or the returns were filed fraudulently, or filed with willful evasion of taxes intention. Okay, so if IRS determine those, and then for those returns there are no time limits. Okay, so if you did fall in, if your claim that does fall into those kind of categories, so even the 5-year does not guarantee that you won't be audited. Okay. All right, so now let's go into those eligibility and as well as the ERC calculation details, and to see some of the areas where you need to pay attention to. So if you haven't filed the claims yet, or if you have already, so then these will give you some ideas about how you should gather the document, so in case you do get audited by IRS on your ERC claims. All right, so for eligibility, there are 3 big categories, or basically 3 ways to be eligible. And the first one is eligibility based on significant decline in gross receipts. And of course, by now, I'm not going through the detailed ERC rules again. So, for example, I'm not talking about whether the threshold for gross receipts decline and those things like that. Okay, so we do roughly for 2021, it's 20% is the threshold, and then for 2020 is 50%. But of course, the details is a little more complicated. I would say maybe even quite a bit complicated than that, just those simple 2 thresholds. So, but anyways, I'm not going into the details, but I do want to mention a few things that may be relevant, particularly in the context of an IRS audit. Okay. So, so the first thing is, how do you count gross receipts? And then we have seen client accounting in all kinds of different ways. So there's but the gross receipts in the context of ERC, they are governed by an Internal Revenue Code. If it's a for-profit business, so that's Section 448C, or if it's a nonprofit, it's Section 6033. So so pretty much, so basically, however you're doing your counting the gross receipts on your income tax return, and then you should use the same way to count gross receipts for each of those quarters that are involved. Okay, so the only difference is the time period, but not the way you do your accounting. So that's the first thing about how you count gross receipts. Okay, and also, so to support your gross receipt determination, so depending on what method you're using, so you may need to do the corresponding financial statement, and in probably also bank statement. So these will be useful documents for you to keep and that will support your determination in the significant decline in gross receipts. And of course, the financial statement here, and that those should be the quarterly one, not the not the annual financial statement, because the eligibility based on the significant decline is a quarter-to-quarter comparison. Okay, so the quarters in 2020 or 2021, and you compare those quarters to the same quarter in 2019, which is a pre-pandemic year. And also, if you own multiple businesses, and if they fall under a control group, so there are criteria. Again, I'm not going into the details. So there are criteria about determination of a control group. And if you have multiple businesses, they fall under one control group. And when you count the significant decline in gross receipts, you have to do the comparison for the entire group of businesses in aggregate. So in other words, you cannot just do one or do those each of the businesses individually. Okay, so that could be good or bad. And so we have seen clients, in both situations. In some cases, the client has, let's say, for example, with two businesses, and when you put together, and that actually made both businesses eligible for some quarters. So in some cases, that may be helpful, okay, because you can claim ERC on both businesses. And in some other cases, of course, if you have one that's doing very well, that didn't do too well, when you put them together, and maybe you don't meet the threshold anymore. And so then, but anyway, so that's a rule, okay? So you have to follow. If you do have multiple businesses, and if they fall under one control group, and then you do have to consider the gross receipts in aggregate. All right, so that's if you base your eligibility on gross receipts. Okay, the second eligibility criteria is government COVID orders. Okay, so if your business were suspended due to compliance with government orders, so whether it's a federal, state, or local COVID orders, if they impact your businesses, and in fact, the word that IRS uses is fully or partially suspended your business operation. Okay, so then you may be eligible for ERC in those quarters, but only for wages that's paid during the period when the government orders were in effect. And so there are a few things you do need to pay attention. So one is that if your employees are able to work from home or remotely, so then that's not considered your business is not considered to be impacted by the COVID orders. So you can still do your operation can still go on, and except that all the employees are at home, so that your business is not considered impacted by the COVID orders. And also the impact on your operation must have more than a nominal effect. And IRS also clarified the nominal more than a nominal effect means more than 10%. Okay, how you measure that 10%, of course, can be. IRS did give some examples, but anyway, so there dependent situations. So there can be different interpretations, but there has you do have to pay attention to that more than nominal effect criteria when you are relying on government COVID orders. And of course, you do have to save copies of those specific government orders. So if you're approached by some of those ERC credit companies, and they just tell you, okay, so you can claim 6 quarters because everybody's impacted by supply chain, for example. Okay, so then you had to take those claims by them with a grain of salt. Okay, and in fact, with a lot of doubt. You do have to do your own analysis. Okay, so what are the specific government orders that you can or were relying on, and so you do want to save copies of those, and in case you are audited, and also you have to be able to tie those government orders to your business. How does that impact your business? Okay, and just because there's a global supply chain issue, for example, it doesn't mean you can just rely on the supply chain issue to claim the ERC. In fact, ultimately you have to say, oh, that supply chain was due to the closure of one of your suppliers, and you cannot find a substitute supplier. So things like that, and you do have to, say the specific government orders that impact your suppliers, and also you do have to provide proof that you cannot find a substitute supplier. So these are the things if you're relying on a supply chain government order, for example. Okay. And also for a lot of IT companies, and so the workers are able to continue to work from home, so then you can even if government there's an order stay at home or whatever the government order were, and that you cannot just simply say your businesses were impacted and you are eligible for ERC under the government order. Okay, you do have to make a detailed analysis. Also, don't forget. So just like the criteria under significant decline in gross receipts, and so there's this aggregation rule, and if you have multiple businesses, and so you have to look at all of them together, okay, and especially when you're measuring the nominal effect. Okay, so if you have one big business, so that, for example, contribute to 95% of your revenue, and so that, and then you have a side business. So let's say maybe 2% of your your total revenue or whatever. Okay, so then when you aggregate them together, so if your small one is impacted, let's say you had to close it down, but the big one you didn't have to. And so then you don't meet the nominal effect rule, because if only 2% of your business is impacted in that example. All right, and the third criteria is the recovery startup business. Okay, so there are a couple of things. And the first one, of course, is very simple. You just have to look at the date when you began the operation. So if the date you began the operation is after February 15 of 2020, so you meet that criteria. That one is a simple one. So you just pull out your bank statement. For example, you look at which day was the first day you started receiving payments from clients. Okay, so that will be the first day you began your operation. And there are some details about basically you have if you made a incidental sale, for example, prior to your grand opening, so and then you probably can still use the grand opening as the actual date of operation, and even if you had some incidental sales before that. But anyway, so there is a cutoff date you have to pay attention. So February 15, 2020 is the cutoff date for eligibility as a recovery startup business. And there's also this average annual sales requirement. Basically, you have to be a small business, and then small business by definition is the average annual sales in the last 3 tax years is $1 million. And so you might think, for example, if you started in December of 2020, and then you're making claims in the third quarter, fourth quarter of 2021, and then the 3 tax years, of course, ending would be, 3 tax years would be, let's say if you're using calendar year, the 3 tax years would be, say 2020, 2019, and 2018. And let's say you had $2 million sales in that 1 month you're open in 2020, okay? And you might think, oh, 2 million divided by 3, and then you're less than 1 million. Okay, no, you do not calculate that way. So, okay, so basically you have to extrapolate into the 3 years. Okay, and so, for example, let's even use it. Let's say you earlier used 1 month. Okay, let's say in 1 month you made 2 million. Like 1 month, December 2020, you made $2 million sales. And if you extrapolate, so that means that 2 million times 12 months in 2020 alone, your extrapolated annual sales for 2020 is actually $24 million. Okay, and then if you extrapolate that into 3 years, so it would be 3 times that, and then you divide by 3. So basically, in that case, your average annual sale is actually $2 million. An average annual sale is $24 million in that example. Okay, and so you do have to be careful to make sure that you do meet the average annual sales criteria. Okay, and also again, don't forget there is this aggregation rules, and if you have 2 businesses, and if one of them starts, and then if they do, after control group analysis, they do fall under one control group, and the one of your businesses started in 2019 or even earlier, and the other one you started in 2021. And so when you look at control group, and your business as a control group started in 2019 or earlier, okay? So, and then in that case, the one that you started in 2021, which is part of your control group, and so cannot, in that case, you cannot claim ERC even for that one business that did start after February 15, 2020. Okay, so much for the eligibility. So we covered all 3 different areas. And so then, if we turn to calculations, so did you calculate your qualified wage correctly? Okay, so obviously IRS will be, if there's an ERC audit, they will be looking at least both areas, both your eligibility and also whether you have calculated your qualified wages correctly. All right, and so first of all, there are several caps. Okay, so including the per employee cap. Okay, and so on this slide, I'm talking about several caps. Okay, so not necessarily just per employee cap. Okay. So first of all, there are per employee caps. So in 2020, it's for the whole year. There's a 10 grand cap annually. Okay, for 2020. And so that does, make the calculation a little more complicated than the calculation in 2021. Okay, and because the ERC claim is by quarter. But when you consider this cap, per employee cap in 2020, and that's actually an annual cap, so we have to keep track of that throughout all the quarters that you're claiming ERC in 2020. So make sure that you did apply that cap annually in 2020. And in 2021, it's a little bit easier because ERC is claimed per quarter, and you only need to make sure that for that quarter and each employee is capped at the $10,000. And also, when you count qualified wages, you can use the qualified health insurance. But the qualified health insurance, you also need to divide it up. Basically, that need to be allocated to each employee. For example, as an employer, you paid say $10,000 total health insurance in a particular quarter, and so you cannot just put that entire $10,000 on the form. So you actually have to allocate that to each employee, and then if the portion that's allocated to each employee, and then you have to take that into consideration when you're applying the $10,000 cap per employee. Okay, so the health insurance will be counted as part of each employee's total compensation, and then so that total compensation is subject to the 10K cap. All right, and so if you're a large employer, which by definition is more than 100 full-time employees in 2020 or more than 500 employees in 2021, so in that case, some employees' wages need to be excluded. Okay, so and then so again, so there are some detailed rules that I don't want to confuse people. So for most small businesses that we're helping with now, you don't have to worry about that. Okay, so but if you do fall under that situation, I would strongly advise you to seek professional advice and about what you can and what you cannot claim that's assuming you're eligible, okay, and when you what you can and cannot count as qualified wages. All right, and for a recovery startup business, okay, and so those are the businesses, remember, that start after February 15, 2020. And so, of course, those same per employee caps still applies. There's a 10K per quarter per employee. But there's also a company-wide or business-wide cap of $50,000 ERC per quarter. Okay, and so then of course to convert what's the qualified wage cap, you divide that by the 70%, and so it's in the 70s, $70-some thousand per quarter. That's a company-wide cap per quarter. All right, so we do have to be careful with all of the caps when you are doing the ERC calculation. And also, there are some other restrictions in the ERC calculation. So you have to exclude certain wages. So first of all, you have to exclude wages paid by PPP or other federal COVID programs such as SVOG or RF. If you're a restaurant, if you're the lucky one that got a RF grant, so then the wages paid by those federal COVID programs must be excluded. And that's one thing. And again, so that's one area that could complicate the calculations a little bit because of the PPP cover period, for example, that typically does not fall into just one quarter. It overlaps with the 2 or 3 quarters, and also it's not a full quarter in some, so, and then you have to be careful in the calculation about how much you can exclude in each, how much you should exclude in each quarter in order to, basically, to satisfy the coordination with other federal program requirements. And the other exclusion is the wages of majority owners' relatives. Okay, and that actually would include the majority owners themselves, typically. And And so the majority owners, and then of course, if you are the sole owner, then of course you are the majority owner, so that's an easy case. But in the more complicated, when you have multiple owners, and there is this so-called constructive ownership rule. And so the constructive ownership basically means that you have to count the ownership of all of your family members. That include your spouse, children, parents, grandparents, and all of that, as well as brothers and sisters. And so IRS actually give an example in their frequently asked questions in their FAQs on ERC. So that's three siblings. Three siblings each own 33%, or basically 1/3 of the shares of the company, and then together they own 100%. So in that case, by the constructive ownership rule, the shares of all three siblings need to be added together, so each of them is considered a 100% owner. They are all majority owners, and then so of course they are all relatives of each other. So they are also relatives of each other, and then so all of their wages need to be excluded in that situation. And so again, so the main thing here to pay attention is constructive ownership when you determine the majority owners in case of when you determine who is the majority owner, so you just remember to use the constructive ownership. Right, and the constructive ownership is actually different from the control group analysis. So these are two different concepts. The control group analysis is more for the eligibility. So that's a different set of rules there, and the constructive ownership is on the qualified wages, determining qualified wages. And who are the majority owner, and then the majority owner's wages need to be excluded. So I think that pretty much concludes what we want to talk about today. Right, and so if you're interested in learn more about those programs as well as other things we covered in our webinars, and you can go to our YouTube channel, youtube.com, Community CPA. And of course, you can also call or email us for further consultations. So we do have a general email address, Catherine@communitycpa.com, and you can also email to our staff directly. For example, you can email me at steve@communitycpa.com, and you can go to our website for more information about our service and for announcement of upcoming webinars. And then you can call our main number 515-288-3188 and to set up a consultation or contact us for other questions. And we're open 6 days a week, Monday through Saturday, from 8:30 a.m. through 5:30 p.m. Right. Thank you for listening, and we will see you next time.